Hey everyone, and welcome. Today, we're going to pull back the curtain on a massive financial story that, honestly, almost no one is talking about. It's all starting in Japan, but believe me, it could send some serious shockwaves right into your 401k, your mortgage, and the entire US stock market.
Okay, let's just get right into it, because your investments, they might have just gotten a whole lot riskier, and you probably don't even see it coming. There's a financial crisis brewing in the one country that owns more of America's debt than anyone else on the planet, and it's threatening to send a tsunami straight into your retirement account.
You see this number? $1.2 trillion. That is how much U.S. government debt Japan is sitting on. I mean, just let that number sink in. It's a staggering amount of money, and it's right at the heart of a financial storm that could honestly make 2008 look small. So what on earth is going on?
To really get your head around how a crisis all the way over in Japan can directly hit you where it hurts, we need to rewind the clock a bit. We're going to look at a financial time bomb that's been ticking away for more than 30 years.
Yeah, this is not some new problem that just popped up. Nope. This story starts with a gigantic bubble bursting, which led to decades of just nothing, economically speaking, and a financial magic trick that has finally run out of steam. I mean, just look at the sheer scale of this problem. Japan's national debt has ballooned to 234% of its entire economic output. To put that into perspective for you, we all know the US debt is high, right? That's at 120%. Japan is literally double that. They are, by far, the most indebted major economy on the planet.
So how in the world did they get here? Well, back in 1991, Japan's absolutely massive stock market and real estate bubble popped, and it popped in a spectacular way. The economy just slammed on the brakes and basically went nowhere for the next 30 years. People now call it the lost decades.
So to fight this deep freeze, the government spent money it didn't have, and the Bank of Japan pulled off this kind of magic trick. They just printed their own money to buy their own government's debt, all while keeping interest rates at basically zero. Seriously, imagine having a massive credit card bill, but you can just print your own dollars to pay it off, and the credit card company charges you zero interest. That's what Japan did for 3 decades.
And this whole free money policy in Japan, it accidentally created what might just be the greatest get-rich-quick scheme in the history of Wall Street, and that is the core reason this problem is about to go global.
It's called the yen carry trade. Now, the concept is actually pretty simple. Huge financial institutions borrow money where it's cheap. In this case, Japanese yen at 0% interest, and then they turn around and invest it where they can get a much higher return, like right here in the United States.
And this slide shows you exactly how it worked. It was brilliant. Step 1, borrow massive amounts of yen for free. Step 2, swap it for dollars and buy a US government bond that's paying, say, 5%. Step 3, you just pocket the difference. It was pure, almost risk-free profit, like a financial perpetual motion machine.
And the scale of this trade, it is just mind-boggling. The total size is estimated to be around $20 trillion. That is larger than the entire U.S. economy. So you see, this isn't some niche little strategy. It's a foundational pillar of the entire global financial system. But now, that pillar is starting to crack.
So here's the absolute crucial point. The math has broken. The whole game has changed. Interest rates are finally starting to rise in Japan, while U.S. rates have actually come down a bit. That once juicy, can't-miss profit margin has shrunk fast. The free money machine is sputtering to a halt, and this is forcing a massive, global unwind.
Okay, so that's the big, scary global picture. Now let's bring it right back home and talk about how this connects directly to your money. This is the moment it stops being a Japan problem and becomes your problem.
So as all those big Japanese institutions start to unwind this carry trade, they have to sell their U.S. assets. And that's mainly that $1.2 trillion in U.S. bonds. It's just basic economics, right? When there are way more sellers than buyers, prices have to fall. And here's the key relationship you have to remember. When bond prices go down, interest rates go up. And that makes borrowing money more expensive for everyone, starting with the U.S. government itself.
The thing is, the U.S. government is already completely addicted to borrowing. Just look at this. Interest on the national debt is now the 3rd largest item in the entire federal budget. It costs over $1 trillion a year. That's more than we spend on national defense. So if Japan, America's biggest lender, starts selling off its bonds, those interest costs are going to skyrocket.
And that extra cost, it gets passed directly down to you. The interest rate on government debt is the benchmark for everything else. That means higher mortgage rates, higher car loan rates, and higher credit card rates.
It also means businesses borrow less, which can totally strangle the economy and cause stock and crypto prices to fall as big players are forced to sell assets to cover their losses.
So, we've covered the problem and how it all connects back to you. If you're finding this explainer helpful, and I really hope you are, please take just a second to hit that like, share, and subscribe button. It really helps us continue to break down these complicated topics for you.
All right, now for the most important part. Knowing all of this, what can you actually do to protect your portfolio from this whole unwind?
Okay, in environments like this one, some sectors have historically done better than others. Companies that produce real physical things, like energy and materials, they often hold up pretty well. Tech companies with what they call strong pricing power, think Microsoft or Apple, brands you can't just easily replace, they tend to be resilient too. And finally, consumer staples and discount stores often do well because, well, people still need to buy the basics, they just look for cheaper options.
Now, on the flip side, you really want to be cautious of companies that are loaded up with a ton of debt, because rising rates will hurt them the most. Banks that have heavy exposure to this trade could get hit really hard. And those discretionary stocks, things you want to buy but don't have to, like from Nike or Macy's, they often suffer when people get scared and start tightening their belts.
So what are some actual steps you can take? First, just take stock of your own situation. How much of your wealth is tied up in US dollar assets? Maybe consider diversifying a bit with things like gold or silver. If you have any variable rate debt, like a credit card, focus on paying that down first. And when you invest, try to prioritize companies with really strong financials. But honestly, the most important thing is to just stay informed and have a plan for what you'll do if the market really takes a dive. Which brings us to our final big question. We are watching the end of a 30-year era of artificially cheap money. Money that has fueled markets all around the world. The great unwind is happening. Now that you understand how it all works, the crucial question isn't if it will have an impact, but what the end of this era will mean for the future of investing as we know it. Thanks for watching.